Welcome to Trading Analysis. This is Lesson 3 of Module 2 in our Price Action Foundations course. In the previous lesson, we learned that every market is always in one of three states: trending up, trending down, or ranging. But here's the next question. How do traders actually identify those trends? The answer is surprisingly simple. They follow swing points. Because if trends are the story, swing points are the words that make up that story. Why most traders draw different charts. Have you ever compared your chart with another trader's and wondered why their support and resistance look completely different? Or why they say the trend has changed, while you're still convinced it's going up? The funny part is, you're both looking at the exact same chart, yet somehow you've created two completely different stories. Why? Because most traders don't know how to identify swing points objectively. Instead, they draw lines wherever they feel important. And trust me, the market doesn't care about feelings. So, what is a swing point? A swing point is simply a place where price changes direction. When price moves higher, pauses, and starts moving lower, you've created a swing high. When price moves lower, finds buyers, and starts moving higher, you've created a swing low. That's it. Nothing complicated. No secret indicators, no magic formula. Just observing where buyers or sellers temporarily took control. Think of it like hiking. Imagine you're hiking up a mountain. You climb, reach the top, take a break, then start walking downhill. That highest point is your swing high. Now imagine you're walking downhill. Eventually you reach the bottom, catch your breath, then start climbing again. That lowest point is your swing low. The market behaves exactly the same way. It doesn't move in straight lines. It breathes, push, pause, pull back, push again. Swing points simply mark those turning areas. Why swing points matter. This is where things get interesting. Every trend is built from swing points. An uptrend, higher highs, higher lows. A downtrend, lower highs, lower lows. Without swing points, you can't define market structure. And if you can't define structure, you're basically guessing. It's like trying to read a book with half the words missing. You might get lucky, but you're probably missing the real story. The mistake most beginners make. One of the biggest mistakes beginners make is marking every tiny candle as a swing. Price moves 3 candles, swing high. Moves 2 candles, swing low. 5 minutes later, the chart looks like someone spilled spaghetti all over it. Remember, not every small movement matters. Focus on the swings that actually change the direction of price, the ones that stand out, the ones that clearly show buyers or sellers taking control. Keep it simple, because simple charts lead to better decisions. The foundation of everything. Here's why this lesson is so important. Support and resistance, trend analysis, breakouts, market structure, smart money concepts. Almost every technical trading concept starts with swing points. If you can identify highs and lows correctly, everything else becomes much easier. If you can't, everything else becomes much harder. Key takeaway. If there's one thing I want you to remember from this lesson, it's this. Swing points are the skeleton of market structure. They show where buyers and sellers changed control. Learn to identify them objectively, and you'll stop looking at charts as random candles. You'll start seeing structure, and structure is what professional traders read every single day. Now that you know how to identify swing highs, swing lows, and pivots, the next step is learning how traders use those areas to find high probability trading locations. In the next lesson, we'll explore support and resistance as zones and learn why professional traders don't treat support and resistance as single lines, but as areas where price is most likely to react. I'll see you in the next lesson.
Goodbye.